Welcome to another episode of the Startup Operator podcast. I have with me today Shwetank Verma, who is a co-founder and partner at Leo Capital, that is a venture capital fund investing in early stage technology-centric opportunities, primarily in India. Shwetank began his career at PwC before starting up in the healthcare space and then heading open innovation at MetLife Asia. He's also the co-founder of the India Insurtech Association. We have plenty to talk about today. So without further ado, welcome Shwetank. Thank you so much for making the time.
Thanks, Roshan. Thanks for having me. Delighted to be here.
Awesome. So maybe before we get started, you could give us a little bit of a brief, in terms of your journey and then, leading to your founding Leo Capital.
Sure, Roshan. Yes, so I've always been entrepreneurial. Built my first, company while I was at university. Sort of the classic dorm room startup. Three of us founded it. We actually managed to sell it as well, which was a great outcome. This was in the UK. So then I trained as an accountant in the UK. Was living in London, this takes me through to about 2007. At which point I thought, it's time to head back to India and in Asia. Then the financial crisis hit, etc., and I moved back, sort of thinking of doing a startup in the region. What ended up happening was I ended up sort of working for a large family office called the Claremont Group, which is a multi-billion-dollar institution based out of Singapore, sort of doing a very interesting investor operator role there, where the part of the role was identifying assets to buy. It was slightly more PE style stuff. But with an ability to do early stage companies as well. So incubate companies or buy companies and run them as an operator. Did that for a while, decided it's time to really try my hand at entrepreneurship. So quit that and built a healthcare startup that you referenced called My Healthmate in India. Again, raised money for that and managed to sell it, lead it to an exit. And it was really sort of founding that startup that helped me realize that while I really enjoy being in the early stage environment, working with early stage ideas and companies, I like a portfolio of ideas to work on. And I think the biggest challenge I had was focusing enough on one idea deep enough to be a phenomenal entrepreneur. So it was that learning, that understanding that led me to sort of say, okay, look, if I want to continue working in the startup ecosystem, the right position for me, where I add most value, is on the investor side of the desk, not on the operator side of the desk. And hence, sort of long story short, which I co-founded Leo Capital to be able to live out that idea and to really work with a bunch of exciting and interesting entrepreneurs and have them sort of create businesses that truly make a difference.
Right. Yeah. So you're probably the first person on the show who has played all three roles. I have had people who've been a founder, they transitioned to an investor and things to that effect. But yeah, you've been a founder, operator, and investor. So you worn all hats and, you gravitated more towards the investor hat because, as you mentioned, you wanted a portfolio of startups or challenges to solve for, right? What are some of the advantages you have having seen those other roles, upfront as well?
So what are some of the advantages I have as an investor, having seen the other roles?
Yeah.
So I think one, of course, is founder empathy. I know how hard it is to translate an Excel model to reality, and how sort of having to hire, fire people to take decisions with very limited information is hard. And you get a bunch of conflicting advice. So I've been on the founder side to see how you have three investors telling you three totally different things, and they're all three on your board.
Right.
And how do you make that decision? How do you, and whatever you do, you're going to end up pissing two of them off, right? Unless you piss all three of them off by doing some fourth thing which none of them have recommended. So I understand the pressures, the lack of perfect information, right? The limited information that founders operate under. So I guess it gives me a better sort of sense of the challenges of building a business, and building a holistic business, not building a business from a sectoral or a functional perspective, right? A bunch of investors with a lot of deep expertise in certain things, say marketing or say product, right? And then everything becomes a product problem or a marketing problem. So I think those are some of the some of the advantages of having lived on the founder side, having raised venture money. I think the biggest thing is I've learned things that I do not want to do. For instance, as a fund, we always respond to every cold email. It doesn't matter where it comes from. You will always get a response from us. Because as a founder, one of the most irritating things was sending emails and getting no response. So I think some of these things we've built, we've consciously tried to build a firm that if we were founders, we'd love to take money from and we'd love to work with.
Right. I want to talk a little bit about what you mentioned in terms of whose advice to take, right? I've heard Vinod Khosla say this as well. One of the most important decisions that a founder will make is to decide whose advice he will take when, right? He or she will take. Do you want to talk about that? I mean, how should a founder go about deciding what advice is relevant when?
Sure. Yeah. It's a really difficult thing, right? And I think Ray Dalio has a fantastic concept of how to decide who's a believable person. And I don't want to sort of go too deep into it. People can look up Ray's work. It's pretty publicly available, and it's around basically kind of work they've done in the past, the kind of outcomes they've achieved in the past, and then anchoring your decision on that, right? I mean, are they believable in this context or they're not believable in this context? So it boils down to that. It boils down to applying your own believability framework and understanding, what are the biases or what are the life experiences of this investor? What are some of the things that he or she has done in the past, and do they relate to your current challenge? And because certain different people will have different sort of backgrounds, different biases that come into your decision making. And then as a founder, ultimately you have to realize that you are responsible for whatever decision you take, right? You cannot use it as a crutch and say, oh, investor X told me this, that's why we failed today, or that's why we succeeded. The success and failure sits with you as a founder. So the ultimate piece of advice is, of course, you have to sort of back your own judgment at the end of it. But I used to actually do a pretty complex and far too complex, in my opinion. I would put everybody's advice in a spreadsheet. I would actually probability weight my assumptions as to how believable I think they are, how much different parameters, right? And then there'd be a probability weighted outcome. I don't recommend doing this, but I'm happy to share with you. That's what I used to do to decide which one to follow. It didn't help.
Right. So coming to your investment thesis at Leo Capital, do you have like a declared investment thesis as such? I mean, I know you focus exclusively on companies in India, and you're focused at the early stage. But do you have some sort of a paradigm that you're looking at specifically?
So we don't focus only on India, by the way. We do Southeast Asia and the US as well, and
Right.
especially India-US corridor. Look, we are bottom-up investors. So we believe that the best entrepreneurs unearth fantastic opportunities and are able to articulate and educate investors on them very quickly. So that's what we're looking for are people applying technology to large markets and creating large opportunities for themselves and their investors. That's the sort of broad overarching theme. And we are very open to listening to entrepreneurs who are applying technology. It has to be technology. We're not going to invest in brick and mortar or hardware, purely hardware kind of plays. That they have a very clear view on how they're going to transform a large, ideally existing, but sometimes, of course, creating a new market can also be very exciting. But for us, ideally existing spend is great. So if you can point to an existing spend and say, look, $5 billion is being spent on X, we're going to transform it with Y. That's why you should back us. That's a great starting point. And then we'll have to get deep and sort of go deep into understanding your TAM, your total addressable market. Your team, what sort of who you are, where the gaps are, what would you need to fill for this to become a large opportunity, and then sort of your product and traction, right? So those things, in our opinion, change the most. So now, in our experience of journeys, right, the biggest determinant of success is the market you're playing in. The market has to be big enough to create a venture style outcome. And unfortunately, very few markets are, and that's where the challenge lies. That 99% of businesses are created in markets that are not big enough for venture capital. So first
Right.
of all, you have to be in that 1% where the market is big enough to create an outcome. And the hard part is it's not easy to identify whether or not you are. TAM analysis is probably the most slippery part of early stage tech investing, even late stage tech investing for that matter, right? People thought Salesforce sort of TAM was 50 billion, and now it's a $200 billion company on its own.
Right.
So getting TAM right is the biggest challenge, and that's where we spend a lot of our time with founders,
Right.
and understanding the team, and then obviously understanding the current
So
product.
let's double click on that a little bit, right? In terms of understanding the TAM, because as you rightly mentioned, forget about Salesforce. I mean, if you look at the SaaS IPOs that have happened over the last couple of years itself, none of us could have imagined that, some of these companies would be of the market cap they are at this point of time, right? It's crazy. And I also believe that, I mean, you wouldn't know 10 years back that a company starting out in a particular space would have such a TAM. So it's a very difficult problem to solve, right? Because obviously along their journey, they will discover new use cases, new markets, new allied sort of solutions to serve, and so on and so forth. So how do you look at TAM going forward? Like, I mean, if you were to extrapolate from where you're starting off, how would you look at TAM?
Yeah, it's a really good question, and I think first I have to say that it's not as if I found the answer and that I'm very comfortable with what we have, or a crystal ball to figure out time. But I think it's what they say, right? Predicting is hard, especially about the future. All right, so it's really important to understand that predicting is hard, and doing predicting in the future is tough. So I like sort of, I forget who said this, but the job of the investor is to see the present clearly. So that's where I like to start, at least, understand what's happening today. All right, so ideally there's an existing spend. You can actually tabulate that existing spend and get a sense of what the current TAM is. At that point, right? I mean, all you can do is run sensitivity analysis, right? So today's TAM is 2 billion, right? Entrepreneur says it's growing 10%, 15%, 20%, right? And you put it in an Excel spreadsheet and say, okay, 20, 30, 40, 50% growth rate over the next 10 years. At what do I need to believe for this company to become hugely exciting? And obviously, the lower the growth rate of TAM, that leads to a hugely exciting outcome, the more exciting that investment is. That's a sort of a long answer to sort of get back to what you're trying to figure out is what is that growth rate of TAM which is believable, and why is that believable? And that is really guesswork, right? I mean, that is you try and sort of, the best entrepreneurs have an explanation why they feel that TAM is growing and will continue to grow at that pace. And as an investor, you have to listen to that. You have to add some skepticism to that. You have to think about competitive dynamics as well, as to how that TAM will be carved up, how value capture in that TAM will play out, and whether the position of this company is the right for capturing value in that TAM. And ultimately, yes, of course, it's a lot of pattern matching and guesswork, and you hope for the best to occur in 10 years.
Right. No, I reference a quote by this, have you heard of Startup L. Jackson? I mean, it was a very popular Twitter handle.
Yeah. He stopped tweeting of late.
Yeah,
right?
he did stop tweeting. So he had this classic tweet that, everyone who came before me, he was talking about angel investing, and he said, everyone who came before me was a dart throwing monkey, and everyone who came after me is a spreadsheet jockey. Right. So
yeah, exactly.
something of that sort, right? So you also spoke about this fact of a VC investable business, and a VC investable business, while TAM is one very critical aspect of it, obviously you want a large sized return to be possible for your investors. What are some other aspects of a VC investable business?
Sure, yeah, TAM, of course. Growth rate is the other one. You can't wait forever. So let me answer the question by asking, why is a VC investable business different from a non-VC investable business, right? So what are the unique pressures that VCs operate under? So in my mind, sort of there, let's say there are three, right? There is there is the fact that the fund life is fixed, right? So the actually there are only two. The fund life is fixed, and because there is no liquidity, the return expectation of LPs is high, right? So it's the intersection of these two constraints that leads to the birth of a VC firm. So now when you have a constrained fund life, that means the company has to grow in that fund life to be valuable. All right. So if it's going to take 20 years, that by definition means that it's not a good fit for VC, because VC life cycles are 8 to 10 years. So that creates a very stringent constraint, because as the VC, my job is to return money in 8 years so that I can continue raising more funds and continue growing my VC, my VC business. So so that immediately limits my universe of investable opportunities, where taking my money today, the growth rate, it will be fast enough that somebody else will want to come in sort of, year 4 to 6 and pay me sort of 10 to 30 times the amount of money that I've put in. So when you put that constraint, by definition, you get to a stage where growth rate of revenue has to be very, very high. And so that is what actually core VC investable is, that the growth rate of revenue is very high, and the market is high enough, is big enough that the very high growth rate can be sustained for 3 to 5 years before it slips a bit, but continues to be very high, right? I mean, very high in VC terms is 100%, right? And in public markets terms, it's 30%. So it's the intersection. That's what creates the unique stresses of venture investing, and that's why you need a large TAM, super fast growth rate, and a sort of an ability to exit the business in a defined period.
Right. Yeah, I think oftentimes we forget that VCs themselves are running a business, and they have their own constraints and pressures, right? So.
Really sorry for the interruption. I'm just going to take a minute of your time to talk to you about something amazing. Move fast, break things. All of that is great advice for when you have nothing to lose. But once you have some base of users and customers, you cannot really afford to risk quality. So how do you still ship at lightning pace and delight your users and customers at the same time? Now that's where Bagasura comes in. Bagasura is a super easy way for people to give and take feedback about the product, and most importantly, close the loop. If you work in a design team, you know screenshots suck. But with Bagasura, you can actually get people to give you very contextual and accurate feedback about your UI and your UX. If you work in a QA team, you know 90% of your time goes in reproducing bugs. But with Bagasura, you can get people to reproduce bugs, document test cases, and resolve things all within Jira itself. Bagasura is being used by some of the leading design and QA teams around, and it's brought to you by the good folks at Mulya Testing, which is one of the best software and QA firms in the world. Do check out bagasura.io, that's BUGASURA.io, and sign up for a demo today. Ship fast and ship well.
Right. So let's talk about some of the sectors that you invest in. I was looking at your portfolio, and you have a very wide spread, right? You're pretty agnostic to sectors that way. So you've spoken about, how you evaluate startups. Let's talk about one or two investments that you've made, and what was the, reasoning or rationale behind investing in those companies?
Sure. Yeah. Do you want me to pick a company or?
Yeah, your call. Pick.
Right. So, going back to the discussion, right? What you need is a company that's growing fast, that is in a large market, and that you can exit in a defined time period, right? Those are the three broad VC pressures on an investment. So let's talk about WayForward, for instance, right? So WayForward provides mental health solutions to US enterprises. So there you have immediately, you can see that the market is large, and it's proven to be large, right? So mental health solutions today, in the old-fashioned way, US, old-fashioned way of going and seeing a therapist, going and seeing a counselor. American enterprises spend something like $300 billion to support their employees, right? So it's an existing very fragmented, very sort of local market. So it's the old sort of, think of it like the old hospitals market, right? I mean, a lot of money spent in hospitals, but it's not digital money, right? It's not if the hospital is in Pune, it's not unlikely to be attracting a lot of patients from Delhi.
Correct.
So same kinds of concept in the mental health market. It's large, but it's fragmented. So that sort of sort of creates an interesting opportunity for a digital tool, right? That's step one, right? There's a large fragmented market. There's a digital tool that can come in. The good thing about mental health is that a lot of the therapies actually can be delivered digitally, right? I mean, there's not that much physical interface required here. You don't need to set a bone. You don't need to do a CT scan. It is more sort of tools, cognitive tools, tests, and conversations. So it leads itself to a digital solution. The willingness to spend is there. The ability to sort of show results is there, and there's a large market. So that excited me about the whole mental health space. And then the second thing down was, of course, the team was very good, right? So the team has a clinical psychologist, has somebody with the experience of building businesses, has a sort of very solid tech co-founder. So the co-founding team covered the main bases that you need to build a business like this, which is sales to enterprise, deep clinical skills, and deep technical skills. So the founding team was complete. Once the founding team is complete, you can always add, like in this instance, we needed to add some senior salespeople, etc. Those are easier to add if you have depth in the founding team.
Right.
So and the third thing, of course, was the market. With COVID, there was a market inflection, and you could see that there was more demand because with more remote work, with more anxieties and stresses, more and more employees were turning to having mental health problems and were looking to their employer to provide solutions. So when all of this came together, it made for a very sort of, I'd say, compelling investment case. And we'd been working with WayForward for a while, so I was very happy to be able to close the investment earlier this year. Yeah.
Awesome. So let's talk about CoverGenius. It's again, insurance is something that's intriguing for the both of us. Talk us through your investment in CoverGenius.
Right. Yes. So CoverGenius, is one of those where the top-down thesis actually makes a lot of sense. So the top-down thesis in CoverGenius is that insurance will go away from being this very heavily sold product to things that are to sort of coverage, which is embedded in the journey that you are doing. So for instance, in travel, right, these days it's already embedded, where when we were traveling before COVID, right, when you used to book on Make My Trip, there was a little tick box that you could tick to get travel insurance. So CoverGenius basically takes that concept and applies it to everything. So whether you're buying a mobile phone or a laptop or jewelry, whatever you're buying online, you can cover it. And then the other level it adds is a level of personalization. So at the moment when you tick that box in Make My Trip, your coverage and my coverage is exactly the same, right? It's one product that Make My Trip is selling. But CoverGenius allows it to be tailored for us. So it might know that Roshan is a, scuba diver and he has some great scuba diving equipment, so he needs more cover than me, who only has a business laptop and quite frankly does nothing else with it. So CoverGenius has built this personalization tech on top of the distribution APIs. So for us, it was easy to believe that a large part of insurance premium will shift to digital only without any assistive sales, and especially digital contextual sales will rise. That was on big tick mark. Second part was they've shown, so existing market, right, $5 trillion of global spend, and CoverGenius had shown some great ability to land the large digital partners that command, the front end, and then shown that the tech works. So again, it was an absolute no-brainer of an investment.
Right. So let's zoom out and talk about Insurtech as a sector itself, right? I mean, again, it's something that you are deeply passionate about. You are the co-founder of the India Insurtech Association as well. What are some of the dynamics in this sector that is favoring innovation at this point of time, and particularly innovation, the kinds that startups can get in and solve?
Yeah, great question, Roshan. So insurance is a very old industry, right? In the sense, mankind for years before they knew the word insurance has looked to its community to protect individual members from catastrophic events, right? So it is one of those innate needs of humankind, right? I mean, it's almost conversation, collaboration, and then some level of tribal protection, right? So in my mind, it is as elemental a part of humanity as anything, and it traces its roots to the dawn of civilization.
Sure.
I think interestingly, over time, of course, the protection element has become further and further away from that community element, right? So, and now it has become an adversarial relationship where literally, there are large, humongous insurance companies who collect massive amounts of premium and then make it very hard for you to get your payout should you need it, right? So as an industry, the NPS is absolutely terrible, right? It's about 10. Everybody more or less hates the insurance company. You can easily find somebody who has a devastatingly poor claims experience, whether it's in life, whether it's in your accident, whatever it is. And the number of people who have something positive to say about their insurance company is few and far between. So when you have something which is a huge industry, huge need, a need that has been there since the beginning of time, and you have a huge customer distrust, yet a massive spend, what you end up with is a sector which is completely ripe for disruption, completely ripe for new approaches, completely ripe for more digital approaches, and that's what we've been seeing with insurance. Now, in terms of insurtechs, they have opportunity across the entire value chain. But obviously, the opportunity in India is a little bit more focused towards new to insurance customers. These are customers who have never bought an insurance policy, not because insurance inherently is so expensive. It's because the layers of admin costs that current business model imparts on insurance makes it too expensive for the average person, and they don't provide the cover, they don't provide the protection that the average person needs. So I think that's the most exciting part, and you have a bunch of companies like Toffee, Gram Cover, etc., addressing that element. The other part that excites me a lot is the part that I think is most broken in insurance is claims, which is a very, very painful process, right? I mean, you still have to mostly fill out manual forms. They ask questions that are absurd, which you do not have the answer to. And in certain cases like death, etc., they require you to go around to banks and to government offices to get stuff stamped or signed or witnessed, which is really not what you want to be doing when you had a bereavement. So I think that's the sort of element that I'm very excited about, sort of parametric cover kind of place, where parametric means that the insurance is provided based on some third party event which nobody has control over. The classic example is sort of rainfall, but this parametric cover concept is being extended to things like internet outage, the sort of yield across many farms, and more people are coming up with even more interesting data sources that can act as a parametric trigger point for insurance policies. And especially in life, I think the ability to just pay a claim based on death certificate, right, which is sort of published to a registry or something, I think is great. The claims with while mitigating for fraud and while mitigating for adverse selection. Just for your listeners who are not sort of deep into insurance, adverse selection is that when you sort of, the only people who buy insurance are those who need it, and otherwise they don't. The people who don't need, because the way the product is structured, you end up buying people who have a very high likelihood to claim. So those are some of the sectors that I see exciting. I think insurance is at a cusp of significant change.
Yeah.
And we will a lot of incumbents will fall behind. A lot of newer sort of startups will rise, but most importantly, there'll be bunch of more micro-focused covers, micro duration, micro coverage, and that will lead to larger cover of people, right? So people will have better risk protection in the near future.
Right. Yeah, I mean, insurance is one of those, especially in India, right? I mean, we are less than 15% coverage, I think, right? And there's only one way that number can go. So essentially, there are two segments to it, right? There's the whole product side innovation and there's the distribution side. I think the distribution side is I would say it's a low hanging fruit. So you're seeing plenty of, startups coming and disrupting there. And even though it's been 5 or 10 years since, like, let's say a policy bazaar and so on and so forth have played, it's still a very opaque process. And sometimes I feel like the fact that the underlying incentives are still very misaligned, right? And you will know this if you talk to any of the sales folks who are selling the insurance, right? I mean, I was in the market for 2 or 3 policies recently, and I had this surreal conversation with this guy. So I was basically telling him that, hey, it's in my interest to buy in February because my plan will change, and it will be lower. And he said, sir, कल कुछ हो गया तो क्या करेंगे आप, right? So it's bizarre. I mean, it's just very weird. But do you expect things to also pick up on the product side of things? Because I mean, right now the cost of like making having a license to create an insurance product is exorbitantly high, right? I mean, you're seeing the likes of Digit and so on. But do you see more on the product side as well?
Yeah, great question. So I think first thing, distribution, you're totally right. A lot of misaligned incentives, too many layers in between, and a lot of sort of gaming of the system as well, right? You'll be told what to answer in a specific question to maximize the chances of getting cover. And those things are being solved, right? I mean, a bunch of newer age data companies are coming along and using your existing data, etc., to improve that. So I see a lot of improvement there. Product, 2 parts, right? I mean, one is, of course, new insurance companies, right? And new insurance companies is a function of regulation. And, the IRDA has given some licenses, hopefully will give some more. And, India has sort of 39 insurance companies, right? The US has 2,600. So you can argue that there is scope for some more. I certainly hope that the regulator will make licensing easier. Because I understand that the regulator has a huge role to play in protecting the consumer. But there are many ways to protect the consumer, and sort of restricting licensing is probably the most
most obvious
at one
way.
level. It's probably the easiest at one level, but may not necessarily lead to the most beneficial consumer outcomes, right? Because you have to balance that, right? So when you restrict license, you restrict the product competition, you restrict the kind of innovation that come to the market, and hence, the consumer suffers a little bit that side. So I understand that there's a balancing act. I really hope that more licenses are granted. But having said that, there are a bunch of incumbents which are being active and sort of thinking about sort of new approaches. But again, those are the guys who are sort of new to have got licenses from 2015 onwards, kind of thing, right? Digit, Acco, Edelweiss, which have not built in a dependence on large agent networks and large bank assurance deals, etc., etc. I think the product challenge happens when you get wedded to a business model. And when you're wedded to the distribution model of agents plus bank assurance, then you need those large products to make the business work. And so the change will come when enough licenses are issued, and maybe India can look at certainly the virtual licenses that the Hong Kong regulatory authority handed out, which limited the ability to do bank assurance plus agent deals. As a way to force companies to do more product innovation and do more real distribution innovation, so that you cover risks and you cover kind of products that are not being offered by the mainstream. Right. A lot of opportunity there, but a lot of it has to be led by the regulator.
Right. Another trend that you see in fintech, insurtech is the APIfication of everything, right? There's this very nice article written by Angela Strange of Anderson Horowitz. I'm sure you would have heard about it, read it also. That every company will become a fintech company at some point of time, right? So your incumbents, that is the bank and the insurance companies will act like a regulatory box, and then they will just expose APIs, and people will build services in and around it, because A, I mean, it's profitable to sell financial services products, and B, it's easier for the startups who are more nimble and more agile to work on customer delight and so on and so forth, right? So what are your comments on this? I mean, do you see that happening already, and do you see, how do you see it going forward?
Yeah, she wrote a great article, and she really hit the nail on the head by linking it to TAM increase as well. So she says,
Yeah,
by
exactly.
adding financial services, your TAM increases 3x to 5x.
Yeah,
So I'm sure pretty much every VC read it and thought about it.
right.
For all what I can say is that we've been thinking about it for a while before the article came out. I'm sure a lot of other people had been as well.
Mm-hmm.
And embedded finance, in our opinion, in my opinion, is a huge opportunity. So the APIfication, the regulatory changes like open banking, PSD2, etc. in Europe that are coming to the account aggregator framework in India, they certainly create very interesting business model opportunities. The low hanging fruit, of course, there is payments, and then you add lending, and those two things are things that can be offered on a lot of vertical SaaS platforms, right? So you have a logistics platform. That logistics platform just added payments. It's going to add lending because it sees the data, and those two things just create a significant expansion in the ability of that company to monetize. So the I guess the interesting thing about financial services is that most of them are charged as a percentage of transaction rather than a fixed fee, right? So your payments is a percent fee cost of the transaction rather than some element of fixed fee as well. But so it grows very quickly, and it grows with the scale of the business. So for instance, if you're doing a vertical SaaS in logistics and you're charging whatever $30 per seat, if you're able to add insurance on that, and the insurance is whatever it is, 0.1% of the gross logistics value, that becomes more than that $30 a seat very, very quickly.
Yeah.
And so that's what's very exciting. So we think embedded finance is a huge opportunity. We are pushing all our vertical SaaS companies towards it. We have already started seeing some early success in adding payments and adding insurance to that. And as I said, as it links to the top line, it creates substantial increase in your top line. Obviously, the margins on all of these things are very, very small, but it's once you get embedded in the workflow, it's just recurring. It just happens on your platform, and it creates a very exciting virtuous cycle from an investor's point of view. Right. So broadly, yes, I think I would advise every entrepreneur these days to think hard about the fintech stack, to think hard about where it can be integrated, and whether you're building it in India, whether it's Setu, Decentro, etc., whether you're building it in Southeast Asia or outside, bunch of companies that are allowing you to just call APIs and integrate things like payments and lending. The CoverGenius, for instance, is one of those that allow you to distribute insurance, again, through an API call. That's one of our investments, as you've noted. And more and more of these startups, more of these API providers are adding insurance layer as well. So it will become very easy to be an embedded finance company. And then you can focus completely on solving the user's sort of key need and making that product very sticky and making sure that you are the one who's running the front end. This creates a challenge, of course, for the back end, where you can then, as a bank, it doesn't matter whether I have ICICI or SBI if the API layer is robust. So it creates a very interesting strategic challenge for the incumbent banks and insurers, but that's a separate topic.
Right. We're talking about the optimism of startups solving these large, sectoral problems in insurance and, finance in general, right? But if you look at the startup ethos of, let's say, fail fast and so on, it's sort of antithetical to the way finance and insurance is usually construed, right? I mean, you're talking about somebody's hard-earned money, you're talking about somebody's life in some case, right? So on and so forth. So what are the necessary guardrails that startup founders in Insurtech or Fintech should think about to make sure that, they're on the straight and narrow in some terms?
Yeah, that's a great question, and fail fast. I think fail fast is overused, right? So fail fast is about making sure you found that you fail fast while trying to find a problem worth solving.
Mm.
Right? I mean, once you found a problem worth solving, it's kind of dangerous to fail fast, right? And and or fail at all, because whoever's problem it is going to be deeply affected if you sort of messed it up. So the fail fast period in my mind comes before the product is live. It is a customer discovery stage. It is about wo- doing what you can to quickly identify whether whatever you're trying to do is worth doing or not.
Right.
Um, so it doesn't really apply once, in my opinion, once the product is out in the market. But from a regulatory perspective, that's why I guess sandboxes, etc., are great, because even with all the best intent in the world, some products will not work out, right? And some approaches may not work out. So the regulatory sandbox, where you limit it to certain number of people, a certain number of policies, right? 5,000 policies, whatever, so that you can make those people whole and you don't have a huge system-wide problem, is probably the best way to go. And as a Insurtech entrepreneur, I would certainly look to get into the relevant sandbox if I'm doing a B2C product.
Right.
The
Okay.
other way to
So,
do it is, of course, is make sure you have a deep pocketed partner, right? So you work with a reinsurer or somebody who, can pick up the pieces, say something goes wrong with your setup.
right. Yeah, the liability will still overarchingly lie with the incumbents in some space, in some sense, right? So, yeah, I suppose, I mean, it's more of a policy and a regulation change to put some responsibility on the startups itself, so they don't go haywire per se, right?
Yeah.
Yeah. So, the VC space itself is under a lot of flux at this point of time, and there are, newer terms and newer instruments and newer types of people entering the ecosystem as such. I wanted your quick thoughts on a few of these things that we're noticing recently, right? So, your quick thoughts on solo GPs.
Yeah, no, there's a lot happening in VC, and AngelList is, of course, at the front end of driving democratization of VC, which I personally think is a great thing.
Mm.
So solo GPs, so far I haven't seen too much of that in India. I think it's more of a US phenomenon at the moment, and it's a very interesting challenge, I think, for venture firms, right? So I think venture firms talk about adding all this value around product, around marketing, PR, strategy, hiring, etc. And the rise of the solo GP is going to bring that into real sharp relief, right? So it's either going to be proven out that or at least some firms really do add value, or a lot of the smaller firms will fall by the wayside, replaced by these larger solo GPs, solo capitalists, as I think as the term is going around these days. So that it's very early days to see how it's a very interesting innovation. Very early days to see how it plays out, but you're already seeing some very large deals done by effectively solo capitalists. At some level, it makes sense, right? Even when you think about venture firms, individual deals are done by partners, right? And while there may be a team supporting them, ultimately it's a partner's conviction and partner's insight that drives a firm to take a decision on investing. So it's basically taking that and sort of saying, why have a whole firm? Why have a partnership? Why have the challenges of managing a investment committee meeting if I know what I'm doing and I'm comfortable doing, and the people who my LPs want to back me are comfortable backing? So I do think that as there's, and also there's more and more capital now chasing private deals. I do think that solo capitals will become a part of the setup. And I think over time it will, sort of play out into exceptional solo capitalists who are able to see the world more clearly, be able to sort of, create, spot the opportunities earlier, or just add value in other ways. And some of those sort of firms which are truly adding value will stay on, and people will decide whether they're good enough or whether they want the life of a solo capitalist, or they prefer some elements of the team, etc., being part of the venture firm.
Right. Okay. Your quick thoughts on super angels. I mean, slightly different, but yeah.
So super angels and solo capitalists, I think, it's different enough, yes, because the solo capitalists are also going towards later stage deals, which have traditionally been the reserve of funds. I think super angels, in my mind, are a net positive to the ecosystem. I don't think they ever compete with venture firms because they're always at a smaller stage of the investment cycle. So they, whatever they do, 100K checks versus a, $800 to $1 million check for a venture firm. So I think in India we need more of them, just so that you get more companies that are to a point where there is in India at the moment there is a supply demand gap, right? There's supply of capital is still limited relative to demand, while in the valley it's not there anymore, right? There is effectively supply and demand have sort of matched each other. So in India there is sufficiently good ideas that can be funded, in my opinion, that are not being funded today because of a paucity of capital. And I think platforms like AngelList and the fact that they sort of create an ability for people to do more investments and become super angels are fantastic, and I'd love to see more super angels. We work with a bunch of super angels, people like Ramakant, etc., and I'd love to work with more.
Awesome. What about rolling funds?
Yeah, truly interesting play, right? Adding to the democratization of the whole financing stack. I think we'll have to see how it plays out. For me, the biggest question is the lumpiness of the quarterly fund, right? So yes, quarterly subscriptions, and that have to be invested sort of in that quarter, more or less, is my understanding. I don't think deal flow works like that, right? So like if I had to force myself to do a deal, my deal flow by quarter, it just won't work like that. Some quarters are fantastic, you do 3, 4. Some quarters are dead, you do nothing. So I think that's the biggest question I have about how a forced cadence of quarterly investing, how will that play out in the long run? Will that force you to do deals you may not have done because you need to do the deal as part of your cadence? So that's going to be an interesting question. But otherwise, again, I don't think rolling funds will fundamentally change the venture industry. I think it's just going to be yet another source of capital for entrepreneurs. But they don't challenge. I don't think they challenge the core reason venture funds exist, which is what the solo capitalists do. I think the solo capitalist is a question on the business model of venture firm as a whole. If the solo capitalist can do as good a job as a venture firm, why do you need a venture firm with its 2% management fee and this and that? Rolling funds, super angels, these are adjuncts. These are complements to the venture ecosystem. They don't challenge the core of the venture firm itself.
Right. So what do you make of, angel investing or VC investing sort of becoming an asset class that a larger base of people are going to invest in, whether it's, HNIs or super HNIs or whatever? It's emerging as an asset class that people are, if anything, people are getting more and more interested in. What do you make of that?
Yeah, I think broadly it's a good thing. There is, of course, it's a so see, each individual startup is high risk, but if you build the portfolio correctly, then the overall diversification and enough bets in the portfolio should lead to not that much risk at the portfolio level. I do think it's something that should be available to more people. It should not be sort of walled off the super rich. At the moment, some of the regulations just make it a access play for just the already rich to become even richer. So I do think that democratizing that is a very good thing, and allowing people to invest in venture is a very good thing. But at the flip side, it has to be sort of managed with some education and the fact that this is long-term money. It locks up, you can't access the money whenever you need it. And there are chances of, I think what is going to be interesting is in venture, the losses come early because the companies that you back that didn't make it become apparent very quickly, right, while the returns come later. So I think it's going to be interesting to see how some of the newer LPs who have not had this experience react to getting a statement from one of their investments, which basically shows that they've lost 80% of their value, right? And I think that's where some education will be required so that you understand. But overall, I think, wealth is made when you compound money for years, right? Currently, if you think about it, middle class people make wealth on their homes because that's the thing that they own for the longest. They can't trade in and out of it. So I actually think allowing venture capital to be open to middle class investing is a great way for them for wealth creation, because trading is hard, so it will just compound by definition. So there is, I think, a lot to be said for allowing more access to venture, and people will just have to learn to manage the swings of venture a little bit. There is a challenge, of course, that a lot of that, perhaps too many funds that do not even return principal. So there are some challenges to think about, but on the whole, as long as you don't put all your net worth into venture, I think if you should have the ability to invest, and you should have the ability to allocate a portion of your assets to venture, regardless of your current net worth.
Right. No, I definitely think it's a net positive, but then, I mean, I think people underestimate the amount of expertise and the work that goes into it, because simply the number of people who have, asked me over the last year or so that, hey, I mean, why not get into angel investing, right? And, I mean, it's just, I think Ritesh Banglani of Stellaris had a great thread on this, talking about the various nuances and essentially, saying, hey, be careful about this. I mean, it's not the average sort of investment class per se. So,
yeah. I mean, so what I said was investing in funds and investing in other people's rolling funds. Invest in a professional. Doing angel investing directly on your own is a very risky gambit, and one that will burn your fingers. And
for sure,
unless you're really, and will burn your fingers when you start, but regardless of who you are, most of the time.
Right.
So I think so. My comments are meant more about investing in rolling funds, investing in angel list syndicates, investing in venture funds, rather than going out and writing 5 startup checks yourself.
Right. So Shwetank, you're based in Singapore. I wonder if you can compare and contrast the Singapore ecosystem and the India ecosystem, startup-wise.
I mean, it's a bit of an apples and oranges comparison, Roshan. I mean, Singapore is a small 5 million market. So it's a very global market by definition. Anybody who wants to build a business here thinks of global markets, because the local market is by definition small. India is obviously amongst the most vibrant ecosystems in the world. It has a deep domestic market. You can actually build for the local market and create a huge outcome itself. So totally different ecosystems, a lot of pluses in both. We are excited about both ecosystems, especially with Singapore having access to the ASEAN market, right? Indonesia, Vietnam, Thailand, etc. So 2 different levels of energy and companies being created. Singapore slightly more enterprise and global companies. India, of course, has both enterprise companies and domestic companies. I guess the level of support here by the government is higher. A lot more grants, a lot more support. But the Indian government is also catching up. I think Startup India's sort of mission has been very successful. There's a fund of funds. The things that will take some more time, but they're getting there. So it's on the right path. But on the whole, the Indian ecosystem is probably one of the most exciting these days, and bunch of new exciting companies being created.
Awesome. So in one of your previous roles, you were the head of open innovation at MetLife, right? And your job is essentially to marry startup innovation with corporate challenges. How do you see that going forward? I mean, there was a time when corporates were totally I won't say antithetical, but sort of closed off to working with startups. But then, I mean, today you increasingly see a lot of startups working with, even the one that I work with, working with a lot of large companies, right? So surely their ability to be open about partnering with startups has gone up. But do you actually see them solve real problems, integral problems to the large corporates? Do you see that happening?
So yeah, it's a great question. And look, open innovation has meant many things to different people, and far too much of it has unfortunately been a PR exercise from the corporate's perspective. So my biggest challenge or fear at the moment is that there are too many PR exercises that corporates run, right? So $25,000 prize for best idea for this. That's a meaningless exercise. Okay, so there's no skin in the game from the corporate. There's nothing in it for the startup, and the corporate has managed to sort of create effectively a PR, for itself. So those things, I really hope they die quickly and they get out of the ecosystem. They just create noise. What I think we need to hold the corporates to is true skin in the game for partnering with startups. And by that, I mean that the challenge needs to be a current business challenge that is actually impacting the business. There needs to be a budget associated with it, which is meaningful, right? So $100 to $1 million kind of thing that is guaranteed to be spent on a solution that is being unearthed by an open innovation process. And then finally, obviously, some level of transparency to actually publish results of what I call implementations. So in my mind, today, what's happened is too much of open innovation is PR fluff with no interest or no ability to actually implement outside of a pilot setting. So, a bunch of pilots are run, hepatitis is endemic and nothing scales. So I'd love to see this whole ecosystem shift to one more of a scale and large bets are what's on the ground, right? What's put on stake by the corporate, and real problems, not sort of high level. I want blockchain, or I want the best idea around 3D printing. Is what's published. So the ecosystem, the corporate startup ecosystem needs to improve a lot.
Right.
But those companies who get it right have delivered truly interesting results. And of course, P&G with their Innovation Connect sort of ecosystem, original ecosystem, probably remains still leader in the space where they publish truly deep R&D problems or truly deep challenges, and the solutions are actually taken to market. So they still remain, in my mind, the leaders. A lot of FS, etc., is just pure and simple PR, not thought through, and they're missing out. They can actually make significant changes if they truly commit to doing open innovation other than lip service.
No, you hit the nail on the head, because a lot of the open innovation that I have seen, at least, is more or less a hammer in search of a nail kind of a situation, right? I mean, it's very innovation for innovation's sake itself, and very little skin in the game, as you mentioned. I think it would be more beneficial for the larger corporates to simplify the procurement process, or in their empanelment as such. I mean, that would add a lot more value as well, and you will have business teams looking for solutions, actual solutions, right, with proper skin in the game, right? So I mean, this has been a fascinating chat. I've learned a lot over the conversation. At the end of the podcast, I want to ask you a very simple question. We're operating in exceptional times. The world is under the grip of a pandemic, right? And you've seen people innovate, tremendously over the course of this year. I mean, who would have thought that, we would have all operated as well, right? So, what are you optimistic for going forward in this, post-COVID sort of a new normal world that we're living in?
I mean, the human spirit is that of constant optimism, right? The ability to overcome challenges. I think for the post-COVID world, I'm optimistic that we'll build back better. There will be some more focus on things like the impact on the environment, the societal costs of whatever we are doing. But it'll take some time, and honestly, I don't think my personal view is that I don't think that much will actually change in the near future. So if I think back and read back to the 1918 pandemic, right, by 1921, the world was more or less back to what it was doing in 1917. I think the current view is over-indexed on our current reality of not travel, etc. People are overestimating the near-term impact of COVID. I do think travel, etc., will all come back, and in sort of 4 or 5 years, the world will look very similar to what it looked in 2019, rather than what the world looks like today.
Right. Well, that's a great note to end the podcast on. Thank you so much, Shwetank. This was awesome fun, actually, and I can't wait for people to listen in. Thank you.
Thanks, Roshan. Take care.
Take care. Thank you so much for listening. If you liked this episode, then don't forget to subscribe to us on your favorite platform and share this episode with all of your fellow startup operators. Also, follow the Startup Operator on LinkedIn and Twitter for more updates. Stay safe, take care, and see you soon on a brand new episode of the Startup Operator.